This is Horizons Middle East and Africa, our top stories this morning. A big, beautiful win for Donald Trump. The president secures his signature $3.4 trillion fiscal package of tax and spending cuts just in time for his July 4th deadline. And check your mail. US trading partners brace for letters on tariff rates from Washington, which Trump says may be sent out as soon as Friday. And maximum pressure. The US ramps up efforts to restrict Iranian oil flows, announcing separate sanctions on companies and vessels as Washington looks to squeeze Tehran's main source of revenue. It's just gone 8 a.m. across the Emirates. I'm Lizzie Burden in Dubai, in for Jemana Basetchi. Happy Friday, everybody. You made it. It is a holiday, though, if you're stateside, and markets closed there, at least in terms of cash trading in stocks and treasuries. But just in time for Independence Day, the S&P hit another fresh record off the back of that jobs report and the expectation that a July Fed cut is dead in the water. It's a different picture today. We've got futures pointing lower on both sides of the Atlantic, and that's because of the trade threat, those tariff letters that Donald Trump is threatening to send ahead of his July 9th deadline. But let's flip the board over to the cross-asset picture, because the focus in this region in particular, but around the world as well, is the oil story. So we're looking at Brent trading stronger today, but really the focus is on that OPEC Plus meeting on Sunday. We're wondering whether there's going to be a fourth straight supply hike from OPEC Plus, and so we're going to talk about that later in the programme. But gold as well, we see at $3,338 a troy ounce. Traders really weighing up whether the reduced Fed bets should be more of a factor, shall we say, than the trade pessimism. But all of that to factor in. Euro dollar at a 118 handle. Let's check in now on how Asia markets are faring with Avril Hong. She's on standby for us in Singapore. Hey, Avril.
Hey, Lizzie. Yeah, despite that positive handover from Wall Street, we're seeing the mood in the Asia-Pacific looking pretty grim ahead of next week's tariff deadline, but also as countries watch out for Trump's tariff letters. The worries, of course, that the Vietnam transshipment tariff deal could form a sort of template for other trade pacts. And then China has also said that it will retaliate if its interests are hurt. So there's not a lot of appetite for stocks in the region. We are seeing mostly declines, with the underperformers, including Chinese shares in Hong Kong. A gauge of them actually declined about 1.5% earlier, led by the likes of Alibaba. It is worth noting, though, that there seems to be an easing of some of these investor concerns that Trump's economic and tariff agenda will cause significant disruption to the global economy. And even if we see these declines into the weekend, it's worth noting that Asia stock performance has been pretty range-bound for all of this week, Lizzie.
OK, Avril, we'll see you later in the hour. We thank you. Avril Hong out of Singapore. Now, it took an all-nighter, but they got it done. President Trump's big, beautiful bill passing through the US House of Representatives 219 to 213, just in time for him to sign it by his July 4th deadline.
There could be no better birthday present for America than the phenomenal victory we achieved just hours ago when Congress passed the one big, beautiful bill to make America great again.
For more, let's bring in our news desk editor, Jill Desis, who is watching it all. Jill, who won and who lost in the bill? Is it a big, beautiful win for the rich?
Well, Lizzie, I think, first of all, just on its face, the bill does include quite a lot of, in the way of Medicaid spending cuts, certainly going to affect some of the nation's poorer. And then you're also seeing quite a lot of, the extension of some existing Trump tax cuts, some additional tax breaks in there. So, I'm really drawn to looking at an economic analysis that was done when this was in the Senate. Remember, this is the Senate version of the bill that ultimately passed, looking at this costing the bottom 20% of taxpayers an average of about $560 a year, while giving an average boost of $6,055 to those at the top end. So it's kind of just brass tacks when you're looking at some of that analysis. Obviously, from the Trump administration side, they're really framing this as something that they say is going to boost economic activity. But this is what it's looking like in the end. We'll have to see kind of how all of this shakes out and how this really comes into play.
But Jill, even though there were these cuts to Medicaid, the final version's costlier than the House's earlier version. So you've got to wonder how much blowback the Republicans should be braced for at the midterms.
Yes, that's right, Lizzie. And I mean, look, at the end of the day, Trump, on this big, beautiful bill, he really only lost 2 Republicans who joined the Democrats. Obviously, every single Democrat in the House voted against this bill. You have to think that at this point, it's pretty certain that this is something that the Democrats are going to use quite heavily when it comes to the midterm elections. We've seen this from prominent Democrats already, kind of playing this bill, framing this bill as sort of a reverse Robin Hood situation. So, we saw going into these deliberations before the Republicans eventually got as many votes as they were looking for, that there was a lot of concerns, not just from the ultra-conservative side, people who were, really pushing for even more cuts than what ultimately landed in the bill, but also from a lot of those swing state Republicans, those in more moderate districts who were really worried about how some of those cuts, those Medicaid spending cuts in particular, were really going to hurt their constituents. I'd say that, those are the types of Republicans who probably have quite a bit to worry about as they head into the midterms, because, again, I think this is something that you can definitely imagine Democrats are going to be campaigning pretty heavily on.
OK, but look, given the bill's passed in time for Trump's July 4th deadline, how much wind does it put in Trump's sails? Is it going to empower him to send those tariff letters ahead of the July 9th deadline?
Yes, well, Lizzie, I mean, obviously this tax bill was, the tariff component of it was a pretty significant part of what Trump's overall economic plan is looking like. I mean, in order to offset some of the debt buildup that you're getting from, extending or starting new tax breaks, I think Trump was really hoping to bring in some tariff revenue. What we've seen from him so far is, he's talking pretty cavalierly about this idea of sending out letters. He said maybe 10 a day to different countries. He's really trying to bolster in, set tariffs in, ahead of this July 9th trade deal deadline you're seeing on your screen right now. I think, we'll have to see how a lot of those deals play out. I will remind you, we've really only seen a couple of deals so far. The UK, which did leave a lot of open questions, particularly when it came to how to address some sectoral tariffs. Vietnam is, the one that the Trump administration announced this week, although from the Vietnamese side, they're saying they've still got some stuff to work out. We're still looking for, agreements from everyone from India, Japan, a lot of other nations that really kind of come into play here. Does something actually get over the line by, July 9th, which formulates an actual agreement between these two countries? Or, is it going to be sort of, Trump just kind of giving everybody a blanket thing again, as he's kind of implying with those letters? We'll have to see. But again, I think it just kind of shows you that, still a lot of uncertainty about how a lot of these tariffs are ultimately going to wind up. Maybe we will get something definitive by July 9th, but we'll have to see.
All right, Bloomberg's Jill Deeses, crucial context. We thank you so much for it. Now, pleasing to the president also was the US jobs report, reliably informed by Bloomberg surveillance, as per his social media. He noted that jobless claims were much lower than expected at 147,000, and that the unemployment rate fell from 4.3% to 4.1% in June. Still, he might not welcome the data's impact on Fed cut bets. The report all but wiping out wages on a July rate cut. We could discuss now with Maurice Gravier, who is Group Chief Investment Officer at Emirates NBD Wealth Management. So nice to have you with me in Dubai.
Thank you for having me.
Let's start on the jobs report and where it leaves the Fed. Is July off the table? Is September off the table?
Well, July is most probably off the table because the Fed needs a reason to cut interest rates. We have no doubt that they will. Our view is that we will see some level of slowdown in the US economy before we see any issue on inflation if this happens. So we believe they will cut. They need a reason. The job creations were high. The unemployment rate is low, maybe not always for the best reason. There is a bit of denominator, but I don't think that July is on the table.
But the private payrolls numbers have shown weakness. Without as many Fed cut price, and when you've still got this economic weakness, where does that leave US equities in the second half of the year?
I think that a bit paradoxically, the fact that the Fed is not about to cut is quite positive for US equities. US equities they are a bit expensive in terms of valuation. We see many reasons to look at other things, but global investors are a bit underexposed to risk overall. And that's an important factor in our view, that we shouldn't be too defensively positioned. And as long as you, we are slightly defensive, but only slightly, because the thing is that as long as you know that you will have, first, fundamentals are sound now, you will have monetary easing. And if you add the fact that people are a bit lagging in terms of return, they don't participate totally, I think it's okay. US returns are probably a bit capped for US equity, but it's not a drama.
But I've seen the case made, right, that foreigners aren't interested in US assets, even if domestic buyers are, and that's the driver of the dollar weakness. And I'm wondering, if that is the case, how much the dollar would have to weaken to get foreign investors buying America again?
Lots of thinking that. First, there is this, classical stocks versus flow. People don't buy that many American assets because they already own a lot, and they are probably already overexposed to US assets. Then the dollar, it's down 11%, trade-weighted average in the first half. It's immense. I mean, for me, it's already a lot. We haven't seen that for maybe 50 years.
But will it go further?
The thing is that will it go further against what? Do you really think that the euro or the yen are super strong currencies? The Swiss franc is, but it's not undervalued, and that's one of the few that is not. So against gold, yes, probably we're still bullish on gold. Against the other currencies, we have some doubt. Even if over the long term, it makes sense to see a weaker dollar. It's still, yeah.
But you're underweight Europe.
Yes, we are.
Why?
Which is a bit contrarian. It's a bit difficult for us to buy this idea that Europe is seeing a huge revival. Yes, we have seen this 180 turn from Germany embracing deficits. I'm not sure it's a good news. Apart from that, domestic consumption is still very tepid. There are tons of debt. We talk about debt issues for other areas, but not that much for the euro area. Valuation, stock market valuation is on historical average.
And do you basically assume that a lot of the defense spending goes to US firms?
That's usually what happens. And anyway, it doesn't trickle down to the economy, to the kind of thing that we would like to see. I'm not saying that it's bad, but we're underweight Europe because we're underweight developed markets. And in developed markets, we're kind of neutral US and overweight Japan.
Yeah, just coming back to the fiscal, because we were talking to Jill about how the big, beautiful bills got through both the Senate and the House, but it's more expensive than the earlier version. You saw this gilt sell-off earlier in the week, spreading to the Treasury market as well. And I just wonder, as you look back on this week, was the market overreacting, or is it even not concerned enough when it comes to the fiscal risks?
I think the question of the debt sustainability is massive and probably overlooked by the market, but it's not a question that would be too critical for now, because there are many things to do in the medium term. For the long term, it's terrifying. With regards to the UK, it's a country that has the ability to first avoid denial and to act when there is an issue. So I'm not too concerned. But the US, you mentioned the big beautiful bill. Frankly, for us, one of the surprises with the Trump administration, we were expecting some government expenses cuts, which was part for us of the investment case. And you're right, this is not the case. So in a way, it's good news to have more fiscal stimulus to the US and to some extent to the world, because that's what happens. But I'm not sure that long term it's the way to go.
Okay, so we'll worry about it later. Maurice Gravier, Group CIO at Emirates NBD Wealth Management. Always a pleasure to have you with me. Thank you. Well, let's get to some other global news. A historic moment, in fact, for China. It's said to be planning to offer cash handouts to families as an incentive for couples to have children. Sources say that the Chinese government is set to provide $503 a year for each child born on or after January of this year. The declining birth rate has been a challenge, of course, for China's economy, with the working age population shrinking. So real about turn there for Beijing. Coming up on the programme, the US is upping pressure on Iran with new oil sanctions. We're going to look at what that means for future talks between Washington and Tehran next. This is Bloomberg. Absolutely. Breaking news here from Donald Trump. So we are seeing him responding to whether Hamas has agreed to the ceasefire framework. He says we shall know over the next 24 hours. He is speaking there in Iowa ahead of the Benjamin Netanyahu visit to Washington. Of course, the Israeli Prime Minister under pressure to agree to that 60-day ceasefire with Hamas, and Trump hoping to secure peace in the region. It will be a focus of the Israeli Prime Minister's visit in Washington, as well as the Iranian sanctions that Donald Trump has announced this morning. So the president speaking there, as you can see. But let's get more on this now. The US has taken fresh steps to restrict the trade of Iranian oil, despite President Trump previously signalling possible relief after bombing Iran's nuclear facilities. Tehran, meanwhile, says that it will continue to engage with the IAEA, and Foreign Minister Abbas Araghchi is reportedly planning to meet with US Special Envoy Steve Witkoff next week. Let's now bring in Dana Kraish, who is Bloomberg's UAE Bureau Chief. Dana, really good to have you with me. Thank you so much for bringing us the latest here. Where does, let's just start with Iran, the US putting maximum pressure on Tehran actually leave the Iran-US talks?
Morning, Lizzie. So it's part of the U.S. campaign of maximum pressure, as you've mentioned, and it's not surprising that they continue doing that, and it is doubtful it would impact the talks or the prospects of the talks that are reportedly going to happen. And those sanctions were in place during and before the 12-day war, as we saw, and there's no reason for the U.S. to stop them now. Now, yesterday's sanctions, or perhaps earlier today, were targeting companies and a quote-unquote shadow fleet of vessels that help Iran exports its crude. Now, whether these have become efficient or not, or actually working, is hard to tell. These sanctions aim to cripple Iran's oil industry, right? Its top source of revenue. But from our own reporting for several weeks and the data is showing that Iranian oil output and the exports to countries like China is still rising and flowing. So it's hard to tell how much of these sanctions are impacting or are achieving the goal of curtailing Iran's oil industry. Now, on the sanctions and from Iran's perspective, they have been sending signals that they're ready to negotiate, they're ready to resume talks, and the reports now there is probable talks next week between the foreign minister Araghchi and U.S. envoy Steve Witkoff in Oslo. And that's, of course, positive. And we saw oil dropping on that report because it simply means that both sides seek to de-escalate completely, and Iran and Israel are committed to a ceasefire. And more importantly, yesterday also Iran said they were still committed to the NPT and they will still work with the IAEA, but that cooperation will be channeled by its Supreme National Security Council. They were saying this is for security reasons. So the cooperation remains, but maybe with different representatives. And as we've been saying throughout the war and before, the ultimate aim of Iran now was the survival of the regime. And for now, it survived, and they want to survive what would come next. So they're simply hedging.
And what do you expect to be the focus in Washington, Dana, when we have Benjamin Netanyahu meeting the president? Do you think it will be Iran, or do you think it will be Gaza?
I think it has to be both. This is the main or the top agenda for Israel. And if Netanyahu is visiting Trump, those will be the main things. It has to be the Gaza ceasefire. And we saw now Trump saying that Hamas, or we'll know what Hamas's response to the proposal, the Gaza ceasefire proposal, will be within the next 24 hours. Hamas itself, via Al Jazeera, we saw earlier in the day, saying that we will respond perhaps by today. So we should know what the outcome of this is. And of course, Trump has said that Egypt and Qatar, the main mediators here with Hamas, should kind of get Hamas to agree to this. So the Gaza ceasefire will be on the agenda. Iran strikes its nuclear program and the status and conditions of the nuclear sites. As we have seen in the past week, there's been a lot of debate on what happened to the nuclear sites, and some satellite images saying, there's now actually some sort of reconstruction happening at the entrance of Fordo, for example. And so this will be on the agenda. And of course, normalization. This is a big thing, and a big foreign policy goal for the Trump administration in the region is to integrate Israel better in the Middle East. And that comes with normalization. Last week's, or actually earlier this week, when Trump signed the lifting of Syria sanctions, the White House released a document detailing that the lifting of sanctions will be based on normalization with Israel, between Syria and Israel. So this is the main, I think, three things that they will talk about, of course, and trade issues after the meeting next week between Netanyahu and Trump.
Yeah. Okay, Dana Qureshi, thank you so much. That's Bloomberg's UAE Bureau Chief. Good to have you with me. Now, I just want to bring you some other breaking lines out of that interview, the moment of Donald Trump speaking there. This is on tariffs. So he says that actually Trump's tariffs are going to range in value from 60%, 70% tariffs to 10%, 20%. He says that they're probably going to have 10 to 12 letters going out tomorrow. Countries will start paying tariffs on August the 1st. He's declined to comment on which countries, interestingly, are going to get the letters, but they are going to be sending those tariff letters to countries as of Friday. So that is today in the UAE, but of course, because of the time difference, he means tomorrow stateside. But the latest lines from Donald Trump, and he has just finished speaking to reporters. So we shall keep an eye on those letters. But coming up on the programme, ride-hailing startup Moove seeks to finance a new fleet rollout. So we're going to turn to Africa next and discuss the company's plans to expand in the US. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Let's get you the latest on geopolitics. President Donald Trump says that he was very disappointed with his conversation with the Russian President Vladimir Putin. He says it doesn't look like Trump will looking stop. Ukraine says its capital has come under a massive drone attack just hours after President Trump said that his latest phone call with Vladimir Putin made no progress towards ending the war. And the war in Ukraine is also straining China's relationship with the EU. Sources tell Bloomberg that Beijing is looking to cancel part of a two-day summit with EU leaders planned for later on this month. It comes as tensions rise over the war in Ukraine, Chinese industrial policy and that unbalanced trading relationship as well. The two sides had already cancelled the flagship EU-China high-level economic and trade dialogue and a digital forum. So relations weakening there, but I just want to get you to the market reaction to those latest trade lines. Trump saying that he's going to send those tariff letters. Tariffs are going to range in value from 60%, 7% tariffs on to 10%, 20%, all these numbers flying at us, and the dollar at session lows. We've got futures pointing lower on both sides of the Atlantic, adding to the losses now as we head towards the European Open. Of course, it's a holiday stateside. Coming up on the programme, we'll look to the oil market, supply concerns ahead of the OPEC Plus discussion on Sunday. That's next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. A big, beautiful win for Donald Trump. The president secures his signature $3.4 trillion fiscal package of tax and spending cuts just in time for his July 4th deadline. And check your mail. US trading partners brace for letters on tariff rates from Washington. Trump says countries will start paying tariffs on August 1st. And maximum pressure. The US ramps up efforts to restrict Iranian oil flows, announcing separate sanctions on companies and vessels as Washington looks to squeeze Tehran's main source of revenue. A very good morning. If you're just joining us, it's just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai in for Germana Basecci. Welcome to the programme, everybody. If you thought the holiday had just started, it hasn't. We've still got news for you, and it's Donald Trump saying that his tariffs are going to range range in value from 60 to 70% to 10 to 20%. So the ambiguity, the strategic ambiguity continuing, but he says that those tariff letters are going to be sent out. We just don't know who to. But look at the impact on the futures picture. Red across the screen in response, despite the S&P hitting that fresh record, another one of them yesterday on the back of that jobs report, because, of course, the expectation is that there'll be no July Fed cut. Flip the board over to the cross-asset picture and let's see how things are panning out there. The focus very much on oil as we head towards that OPEC Plus meeting on Sunday. We're going to be discussing that in just a moment. The expectation is, though, of a fourth production hike, a fourth straight one. So we've got Brent trading at $68 a barrel. The Bloomberg dollar spot index, off the back of those tariff headlines, has been at session lows. And on the flip side, you've got euro dollar at a 117 handle, gold here at $3,340 a troy ounce as we pass those trade headlines, as well as the expectations of fewer Fed cuts this year. But let's check in on how Asia markets are faring. Avril Hong's in Singapore for us. What's happening where you are, Avril?
Yeah, Lizzie, I think investors here are also trying to digest those headlines from Trump about tariffs. We've been discussing, even prior to these lines dropping, that investors were watching out for the July 9th tariff deadline, as well as potentially these tariff letters coming as soon as Friday. Now Trump saying that the countries will start paying tariffs from August 1st, but no clarity quite yet, quite ambiguous on these extent of the tariffs. Ultimately, what kind of levels are we talking about here? So it's interesting to see that amid all this in the past, I think 15 minutes or so, that the news has dropped. We haven't actually seen the region's benchmark nudging very much. Note as well that Hong Kong mainland markets, they're still on a break. So when they reopen, maybe we see a bit more of a reaction in terms of markets. But aside from that, worth noting as well that when it comes to the Japanese yen, against the backdrop of a bit of the slide on the Bloomberg dollar index, we are seeing a bit of more firmness creeping in through the Japanese currency. Lizzie.
OK, Avril Hong in Singapore, we thank you so much for that update. Now, let's get into the oil story, because we've got oil trading slightly lower. Brent's down 0.3% at $68 a barrel. And this, as I say, is ahead of that OPEC Plus discussion on Sunday that's set to deliver another oversized production hike. Now, the alliance is discussing a further increase of 400,000 barrels a day from August. And, of course, that risks causing a supply glut later in the year. For more, we're joined by Stuart Livingston-Wallace, our executive editor for MENA and Russia. Stuart, thank you so much for making time. I wonder if this production hike is now inevitable.
Yeah, and more to come, I suspect, afterwards. So the key players here are Saudi Arabia, and I think to a lesser extent probably the UAE. And the Saudi Arabia in particular, I think, is absolutely fed up with carrying the weight for everyone else. So as you remember, for several months they tried the strategy of trying to keep supply down and therefore raise the price, and that completely failed, largely because you had members of OPEC Plus cheating, you had a changing economic dynamic, and I think they effectively came to the realization they have one of the lowest cost production in the world. Why on earth would they restrain production to the benefit of everyone else?
Well, just briefly, does sweating work, and is everybody as happy about this as Saudi Arabia?
No, but they're the big player in the market, and they've got something like 2.5 million barrels of spare capacity sitting there. So if you look at today's oil price, you multiply one by the other, they're effectively leaving somewhere between $100 and $150 million on the table every single day. And at a time when they're trying to do this trillion-dollar transformation of their economy, they really need it. You know, they've had to go out into the debt market far more aggressively this year than they have in any previous year. So it kind of makes sense for them.
But if this is going to be the fourth production hike, is there any sign so far that it's making a dent on Iraq and Kazakhstan?
No, not to some extent, but I think you have to think of it on a global basis. So it's not just those countries. They're looking at the shale patch in particular, you know, which is probably still making money around the $50, $60 a barrel. But again, the production costs in the shale patch are nowhere near what they are in the Gulf, you know, and particularly Saudi Arabia, where we're talking about a handful of dollars to get every barrel out of the ground versus, I don't know, $40, $50, $60 to get it out of the ground in the shale patch. So that's what they're competing with effectively.
OK, thank you so much, Stuart Livingston-Wallace, our executive editor for MENA and Russia. Now, I want to stay on the oil conversation. Let's get some analysis now. We've got Sara Vakhshouri, who is president and founder at SVB Energy International. Thank you so much for joining us, Sara, this morning. We've got got so many headlines to factor in here, but, you know, when we were thinking about the Iran-Israel conflict, we were getting warnings that oil could go to $130 a barrel. Now we're looking ahead to the OPEC Plus discussion on Sunday, and it seems like the actual threat to the market is oversupply. What are you thinking at this point?
Well, yes, definitely. We were just weeks ago. We were in a conflict that the whole world were kind of expecting. Iran-Israel war could intensify. There were worries about security of infrastructure and actual physical supply of oil. So there we had a premium, risk premium on the prices. Then we had the ceasefire that reduced the prices. Definitely that risk premium was kind of starting calming down, tapering off, and a market adjusting itself. And now, of course, the market has different expectation from the upcoming OPEC Plus meeting.
Well, our Bloomberg NEF analysts expect global output to exceed demand by more than 1 million barrels a day by the end of the year. Is that about right? And where would that leave the oil price by the end of the year?
So this is, when it comes to number, there's lots of discrepancy between data. It depends on which data you're looking. Which direction you're going to take. There's a lot of expectation and speculations, multiple data agencies, and depending on what is your assumptions, definitely you're going to have different results. What is clear, as you just before our discussion, you in your program, they were discussing President Trump's tariffs. All of this, where the results coming, could have different impact on the demand. We just had a few days ago the ceasefire and President Trump giving positive signal to China that the economic stability of China matters to the United States. He said it's okay for China to continue purchasing Iranian oil, which was not about volumes of Iranian oil, but mostly giving a signal, positive signal toward China and its economic stability. So depending on where these tariffs are going, we now have multiple delegations from around the world, from African countries to multiple countries in Washington, constantly negotiating over these tariffs. So where all these tariffs are going, they're all going to have impact on the demand. So we cannot really be sure that how much we're going to have the demand growth over supply or balance in the market. What is clear is that OPEC is regularly meeting throughout the year, and depending on where the market fundamentals are and how the market balance is shifting, they're going to adjust their production.
Well, I want to come back to Iran, but, you know, you talk about the trade hit to demand. What about the jobs report yesterday? It was stronger than expected. Doesn't that encourage you on the demand story?
Exactly. So the factors and the elements that are going to really define the short-term demand, even until the end of the year, are all fluctuating and changing depending on where things are heading. Depending from the economic growth, job creations, and tariffs. Also, on the other side, when we're looking at supply, we have to yet to see that where the supply is heading. Definitely, President Trump's negotiation style is showing the parties both the incentives and the punishment. So we see that while President Trump, during the ceasefire announcement, announced that Iran can continue exporting oil to China, yet we had yesterday, on Thursday, the signals from Washington, additional sanctions to kind of ahead of the talks with Iran, showing them that Washington is ready to tighten and close some of those illicit channels that Iran used to circumvent the sanctions. So everything could move any moment. All these factors could change. That could both impact the market fundamentals, both on the supply side and demand side. Again, I would say that since COVID, the OPEC has been kind of this source of somehow stability because they're regularly meeting. And in these meetings, they try to somehow adjust their production. But yet again, as was discussed before with your Middle East reporter, we have the issue of compliance, Saudi Arabia's patience. So we shall wait and see. But again, to my eyes as an expert watching the market, OPEC still is a stabilizing factor in the market, trying to adjust its production to kind of create that balance in the physical market.
Yeah, and you can see that weighing on the oil price this morning. Sara, so good to have you with me on the programme. That's all we've got time for. Sara Vakhshouri, President and Founder at SVB Energy International. We thank you. Coming up on the programme, a potential deal between Blackrock and Aramco. We'll bring you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. To a Bloomberg scoop now. Bloomberg has learned that Blackrock is in talks for a potential deal with Saudi Aramco. The asset manager is considering selling its stake in the leasing rights to Aramco's natural gas pipeline network back to the energy giant. For more, I'm pleased to say we're joined by Alex Dula, our money and power reporter here in the Middle East, who is behind that scoop. So, Alex, just tell us why Aramco is buying back the stake, because it does mirror a similar move by ADNOC last year, right?
Hi, Lizzie. Thanks for having me on. Yeah, no, I mean, this is potentially huge news if it goes through, that BlackRock has been considering the sale of its stake in the leasing rights to Saudi Aramco's natural gas pipeline network, and they might be selling it back to Saudi Aramco. So, you know, it's a huge deal if it goes through, because the BlackRock led the consortium that acquired those leasing rights back in 2021, and that deal was around $15.5 billion. So, you know, if it does go through, it's a huge deal for both BlackRock and also Saudi Aramco.
Okay, and so are we going to see more like this from Aramco then?
Yeah, I think so, potentially. I mean, it's a difficult one because Aramco's debt levels are, you know, they're near a 3-year high at the moment. So it's a difficult time almost to be acquiring such assets. But I think it sort of suggests, in my view, that, you know, Aramco is seeing an increasing value in increasing its stake in a business that's vital to the kingdom's energy infrastructure. And I think it sort of plays into a bigger trend where we saw in Abu Dhabi, the asset manager Lunate, it bought back BlackRock and KKR's 40% stake in ADNOC's oil pipeline last year. So we are starting to see this as a bit of a trend in the market, and it'll be interesting to see how it plays out.
Okay, it certainly will. Alex Dula, our money and power reporter, we thank you so much for bringing us that scoop. Now, let's go to Africa, where ride-hailing startup Moove is close to raising $1.2 billion in a debt round to finance a rollout of autonomous driving fleet with Waymo and Expand in the US. For more, let's bring in our Nigeria Bureau Chief, Anthony Osei-Brown, who I'm pleased to say is still here with me in Dubai. Nice to have you with me.
Yeah, thank you.
Just talk us through the details on this. This is exciting.
Yeah, it's actually exciting that a company that started in Lagos is able to raise $1.2 billion in debt. That's something that would have been unheard of years ago, but that's significant, and it just shows how African startups have grown in the last few years, especially those from Lagos. Lagos has about 4 unicorns now. Moove is likely to become a unicorn. They are calling it a Sunicorn. It's valued at around $750 million based on its last raise, but there's an expectation that it's going to raise about $300 million soon, and that will make it a unicorn. So it's huge for the African startup space.
I love that term, Sunicorn.
Yeah.
Of course, they've got huge expansion in the US, but this region's important for them too, right? The UAE. What is it going to actually mean for the local service?
Yeah, you'll likely see increased fleet deployment. They are basically into EVs in UAE, and it has to be profitable to finance $1.2 billion debt. That's huge. So you need your operations in UAE to be profitable, generate enough cash flows so that you'll be able to finance, because what they are doing in the US is more of a test run, autonomous vehicles, so likely not going to be profitable anytime soon. So you're likely to make sure that your other businesses, especially places like UAE, where they are deploying EVs, they are likely to deploy more, make it more profitable so that they can fund their US operations. So you're likely to see more fleet deployments in UAE, more job opportunities for the local population.
Well, maybe next time I'm here, I can hail one. Anthony, Brown. Oh, when you're here, of course.
Yeah.
Hearing from Nigeria, our Nigeria Bureau Chief. Thank you so much.
You're welcome.
Well, coming up on the programme, young South Africans are being priced out of Cape Town's booming property market. So we'll bring you all the details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Now, President Trump's America First agenda has opened the door to the BRICS to challenge the US-led global order. And it's something that the Bloomberg Originals team has been exploring. And they've been looking at the bloc's rising economic and political clout and asking whether it can truly unite as a counterweight.
This is a story about how the world's most powerful, richest country is slowly losing its influence.
And it's evident here.
We can see across Brazil, thousands of Ford cars almost disappear.
Meanwhile, China's BYD is becoming increasingly common. It's evidence of the growing connection between Brazil and China, the B and the C of the BRICS Plus coalition. This is a group that hopes to rival the US-led G7.
Over time, more countries started expressing interest in joining BRICS. So now there are 10 countries.
10 countries equals economic power. Look at how the original BRICS have grown compared to the G7 in terms of global GDP since 2009. It surpassed the G7 in 2019. Now add in the expanded lineup, and its share is nearly 40%.
The trajectory is clear. BRICS countries are growing faster.
This mantra,
America First,
has created an opening.
The trade war increased the solidarity between BRICS nations.
They want a multipolar world in which there are multiple centers of geopolitical influence.
But can these countries unite to become a meaningful global force?
It's very effective as a symbolic grouping, but how that evolves is probably going to depend to some degree how all their individual economies do, how they perceive the US is moving economically and politically, and how seriously they themselves want to move on big global issues.
And subscribers can see that original Bloomberg Originals documentary in full right now on the terminal and on Bloomberg.com. It'll also be on YouTube a little later, so don't miss that. Now, I want to zoom in on the S of the BRICS. South Africa's first generation of citizens born after the end of apartheid is able to buy property that was once off limits to their parents. But there is another catch here, another obstacle to home ownership, and that's the price. Nowhere is this more evident than in Cape Town, home to Africa's most expensive real estate. And for more on this story, I'm pleased to say I'm joined by Bloomberg's Loni Prinsloo. Loni, thank you so much for making time. Just talk to us about how Cape Town property prices and price growth compares to other South African cities.
Hi, Lizzie. Yes, so as we said, Cape Town is currently the wealthiest property market in Africa. And we've seen in the past 10 years about 160% growth of property prices, compared with something like Johannesburg, that is the richest city still in Africa. Johannesburg only showed half that growth. So, yeah, Cape Town is really flying when it comes to pricing at the moment.
And what's the ratio of foreign buyers in the city, and what's the allure for foreign buyers?
So when it comes to those more expensive properties, so 10 million rand, which is about $570,000, we are seeing quite a lot of foreigners buying in. I think it's about 40% currently of all buyers in that category. So it's just increasingly becoming quite a hot property market. We're seeing a lot of UK buyers, we're seeing a lot of German buyers and a lot of US buyers. Yeah, and the allure is, it's beautiful. So Cape Town has the iconic Table Mountain. It's next to the Atlantic Ocean. It's quite well run. It has a lot of infrastructure compared with some of the other African cities. And it was most recently actually voted the best city in the world by Time Out magazine. So yeah, plus it's still relatively cheap compared with other developed property markets.
And just finally, what's the Cape Town City government actually trying to do to help young people, the born frees, to get their hands on their first property?
Sure. So as you said, the born frees are people born after white minority rule, 1994, and they're trying to get a foothold into this property market. They have good jobs. They have tech jobs, which is quite a big sector in Cape Town. They have finance jobs. But still, it's quite difficult to get in. So the city is discussing financing options with banks. They have quite a few products that they are rolling out quite soon, and they're in supply. So they are approving sort of pre-approved plans, different building materials to sort of speed up supply in terms of housing in the city.
OK, Loni, thank you so much for bringing us that story. Loni Prinsloo, so good to have you on the programme. Now, just before we go, I'm going to just remind you of these lines out of Donald Trump. He's been speaking to reporters on tariffs and a range of other topics, but he says that tariffs are going to range in value from 60 and 70% to 10 and 20%. So essentially, if you're in the high bucket, it'll be 60 to 70. If you're in the low bucket, 10 to 20. But of course, we know that these numbers are prone to change. The big point is he's going to be sending those tariff letters out today. It's already Friday here in the UAE. We just don't know which countries he's going to be sending them to. And you can see the market reaction now. Let's just bring up futures. They're pointing lower stateside, although, of course, it is Independence Day, so US markets are closed for cash trading in stocks and treasuries. But it's weighing on the European futures picture as well. Euro Stoxx 50 futures down 0.4%, as you can see on the screen. The dollar had been at session lows earlier in the programme. It's pared some of those losses now. And if we just flip over briefly to the oil space, you can see Brent weaker 0.3% at $68 a barrel ahead of that potential production hike on Sunday from OPEC+. But that does it for Horizons Middle East and Africa. Jemana will be back on Monday. Stay with me now, though, for Daybreak Europe.